Hi, Tracy. How are you?
Good, Heather. Happy Wednesday.
Happy Wednesday. Thanks for.
You're a busy lady. I love it.
Oh, yes, trying to keep up with you.
Oh, stop it. I thought we could just talk about like the three letters PMI today. What do you think about that?
I love it. I love it. So, PMI, what does that stand for?
Yeah, so I get it asked a lot from people that are looking to purchase a home, and it stands for private mortgage insurance. And
Mhm.
I just had a conversation with someone because they wanted to put 20% down to avoid PMI, right? So on conventional financing, you have to put 20% down. But what they didn't realize is that the payment on PMI or private mortgage insurance was going to be like $50 a month, right? So they could reduce their down payment by 5% and have a
Yes.
really small payment added to the mortgage that eventually could fall off once they hit a certain percentage of equity. So I wanted to try to educate people on that, where, when they have mortgage insurance, when they don't, and that it's not a bad thing. I think a lot of people think of it as something negative. Have you heard that at all from your buyers or?
Yeah, I think a lot of people, at least in my network, look at it as a negative because it's just another cost to their
Yeah.
monthly, an add-on to their monthly payment. Now,
Yeah.
how do you determine, not you specifically, but how is it determined how much that private mortgage insurance will be? Because I've
Yeah.
seen anywhere from $50 up to almost $400. So
Yeah.
what determines the um amount of.
Yeah, that's a good point. So if you're putting, let's say, 5% down, you'll have a higher premium than if you put 10% down or 15% down. FICO score is a big factor.
Okay.
So generally speaking, like if someone had a 620 credit score nowadays, their private mortgage insurance rate on a conventional loan could be over 1%, right? And FHA now is 0.55%. So we'll always compare the two loans, because in that case, it would be less expensive monthly to go FHA versus conventional. So credit score is huge, down payment, and also they look at debt to income ratio. So
Okay.
you have to make sure that your debt to income ratio is going to be below 50% before the mortgage insurance. And then when it gets added, it won't exceed that, because that's Fannie Mae's guidelines and Freddie Mac. It's 49.99 is the maximum debt to income ratio that you could have on a loan.
Got it.
So, and that's conventional financing, and FHA is different.
Yeah. So all the things that you're already looking at for pre-approval and qualifications, these is just another layer, basically.
Yeah, and there's multiple mortgage insurance companies that lenders have access to. So we have like Radian, MGIC. So what we do is we go in and we try to shop the best price. So and it doesn't cost anything to the client. Obviously, we just take the information we already have, we put it in a system, and it reads the best price with all of the mortgage insurance companies that we have access to, and that's the one we end up putting them through, just so we make sure that we're getting them the best deal.
Okay. And then one more little note, when does it fall off?
Yeah,
So
that's a good question. So conventional financing, if you start with mortgage insurance, you have the ability to remove it. One, if you refinance and you have 20% equity.
okay.
If you're in a really low interest rate and you don't want to refinance, it depends on how long you've owned the home. So if you've owned the home for at least like 2 years, you have to be at 78% loan to value. So you have to have 22% equity in the home. And so all you would have to do is you'd have to contact, it's called your servicer. It's who you make your mortgage payments to. You would let them know that you think your home is appreciated enough to have the equity to remove the mortgage insurance, and they'll tell you what their process is. It's different for every servicer or every lender that holds a mortgage. And so they'll do a value opinion of your property. They'll check your balance, and then they may have some other requirements. And once they approve you, then it goes away and you don't have to refinance in that case.
So that's great. Great
Yeah.
tip.
Yeah.
So thank you for sharing that.
Yeah. FHA is a little different though. I want to make sure people get it. So with FHA, if you put less than 10% down, you'll have the mortgage insurance over the life of the loan unless you refinance. So you don't have the ability to have it fall off. If you put 10% down or more, which most people won't go FHA if you do, then you could actually look to remove it after a certain period of years, but it'll be longer still than conventional. But the premium is really affordable. FHA, I mean,
55%.
yeah, and you know, you were saying earlier where people think that stigma of a higher payment. So, you know, if you take a $600,000 sales price and you do 5% less down, that's 30 grand that stays in your pocket for an extra maybe 50, 60 bucks a month, right? I mean, you divide that by 60, that's, I mean, 41 years of, you know, of
What could you do with an extra 30 grand?
exactly, because people, you know, tend to buy a home and they leave themselves really short. They don't leave themselves with reserves, and then you're going to want to do repairs. Things are going to break, you know, you're going to want to get new dishwasher and things like that. So I always try to tell people, if it's all of your money, you know, keep a little bit, and you don't have to put, you know, 15% down. You can put 17% down or 18%. It doesn't have to be exact numbers.
And that's what I love about you, Tracie, is you're really sitting there and looking overall for the buyers to give them the best perspective of what they're looking at. So you're not just, hey, this is what it is. You're giving them options. So
you have to. And there's even options nowadays where people can choose their term. So, you know, if people don't want a 30-year mortgage, they can do 29 years or 28 years or 27. And we have something called exact rate with one of our lenders. So you can do an exact interest rate where it doesn't always have to be just an eighth, right? Which will be an advantage to you over time. So there's a lot of things that we can look at for buyers or people that own a home, maybe that are looking to refinance or pull cash out, that will help them overall in the long run.
absolutely. So there you have it. If you have more questions on the market conditions, how to buy a home, how to get started, or how to sell a home, you know who to call. This is Heather from eXp Realty and Heather Jones Homes. And Tracie.
It's Tracie. My name's on the thing.
So thank
Thanks,
you so
Heather.
much.
Bye. Talk to you soon.
Bye.